This conference will now be recorded.
Good afternoon, everyone. This is Kathy Neifeld with Agency One. It is Wednesday, May 20th. And once again, it's the continuation of our lunchtime webinars. Today, we are going to be talking about the economic market outlook and safe money solutions that you can discuss with your clients. I am pleased to present friends from Lincoln Financial who are going to be speaking during this presentation, and it will be moderated by Craig Baumgartner, who, as all of you know, is not only our illustration specialist, but he oversees our annuity division at Agency One. Craig is going to be interacting with our friends from Lincoln and will be introducing them. If you have any questions regarding this presentation, please don't forget to type them into the chat box, and we will do our best to address them. So without further ado, I am going to turn this over to Craig Baumgartner. Thanks, Craig.
Thank you, Kathy, and thank you, everybody, for taking some time this afternoon to join us on the call. As Kathy mentioned, we are fortunate to be joined by two gentlemen from Lincoln Financial Group, Matt Berger and Tim Gilfillan. Matt is an Assistant VP of Client Investment Strategies for Lincoln. He is responsible for communication and messaging on investment-related topics pertaining to Lincoln's product lines. He is a certified investment management analyst with 15 years industry experience, 13 of which have been with Lincoln. In the first part of the webinar today, he's going to provide an analysis on what has been happening with the markets recently, as well as an outlook on what to expect in the future. Note that there are no slides for Matt's portion of the webinar, so if you don't see anything moving on the screen, you're not doing anything wrong. And then in the second half of the call, Tim Gilfillan, who is the Regional Sales Director for Fixed and Indexed Annuities, will talk about the importance of helping your clients build confident and robust financial plans through the use of safe money alternatives. So without further delay, I will turn it over to Matt.
Great. Thanks so much, Craig, and thanks to Agency One for having us on the call today, everyone that joined here. As Craig said, my name is Matt Berger, and I help lead our client investment strategies team with Lincoln. Now, just a little bit of background. My group has quite a few functions, but really at the core of it is acting as an investment resource for both internal stakeholders like Tim and external stakeholders like yourself, and it's really across all of Lincoln's line of business, from annuities to life insurance to retirement plans. And my point of bringing that up is that we are completely agnostic to product and really truly focus on providing information and being a value-added resource. So with that in mind today, I've been asked to cover what's happening in the markets and the economy specifically, and I'm going to do that. But before I do, I just want to point out that I myself am not an economist, but through my role, I do have the privilege of speaking to and really learning from some of the top industry experts every single day. And that really helps me and my team stay very well in tune with what's happening. And a big part of what I do is to synthesize this information and communicate it with folks like yourself. So today, in the next 10 minutes or less before I hand it over to Tim, I'd like to cover three things. Number one, where do we stand right now from an economic and market standpoint? Number two, what got us here? What's happened to kind of get us to this point? And then number three, where do we go from here? So on point number one, where we stand now, I think one thing that we can all say for sure is that we are in a much better spot than we were 2 months ago. But I think it's important to recognize that it's still a place with a ton of uncertainty about what's ahead in the future. So first, from an economic standpoint, it's pretty clear that the lockdowns that were imposed to really help slow the spread of coronavirus, they have had just an unprecedented impact on the economy. The data that we're getting on a daily, weekly basis, it is just historically bad. So just a couple examples, a lot of you have probably seen this, but want to illustrate the point here is that we've had more than 36 million Americans lose their jobs, file for unemployment in the last 2 months, so in the last 8 weeks here. Just for context, during the entirety of the financial crisis and the Great Recession there, 8.7 million lost their jobs. So a staggering number there. Second quarter output, so GDP is projected to fall, depending on where you look, anywhere between 38 to in the mid 40s in terms of percentage annualized on a year-over-year basis. And this would be the largest quarterly decline in GDP in quite some time, really going back to the Depression. I mean, if you look at the financial crisis, the largest during that was only 8.4%. So again, just staggering numbers that really show how severe the impact to the economy is right now. But if you look at it from a stock market standpoint, the picture is completely different, right? I'm sure it's not news to anyone on the call today. There's been a pretty big rally off of the lows we saw in March. But really to drive home, again, how massive this rally has been, we're up over 30% since then. I mean, if you include what's happening today, it's actually closer to 32% since the low on March 23rd. So it's one of the fastest 30% rallies of all time. And since we're talking about where we are now, one of the consequences of that is that by most valuation metrics, stocks have become pretty expensive, right? Because you've had this rally in prices along with earnings, corporate earnings falling back. And it's really resulted in stocks, if you look at forward price to earnings ratio, they're really about as expensive as they've been since 2001. So just one thing to think about from the standpoint of where we are right now. So again, just to recap in terms of where we are, stocks have rallied quite a bit. We're only about 11, 12% below the all-time highs right now. But at the same time, you've got this economic data that keeps pointing to the worst decline since the Great Depression. So in other words, there's a massive disconnect between the pain that's being felt on Main Street and asset prices on Wall Street. So I think the natural question is, what gives? Why is this happening? And that leads, I think, really well into point number two, which is kind of what got us here. And I believe there's three main things that have driven stocks higher, but they all really connect back to one main point, an important thing to remember, and it's the fact that the stock market isn't the same as the economy, right? Things are very, very bad right now economically. That's a known. But stocks tend to look past what's happening now, and they look towards what's expected to happen in the future. And what the stock market rally is telling us is that the market thinks we've kind of hit the low, right? The worst is behind us, and it's looking towards a recovery in the back half of the year and in 2021, and that's really come into focus. And there's, again, as I said, there's three things that have really contributed to the recovery that we've seen. Number one has been news on the virus itself, right? When we started to see evidence that social distancing was working, that the virus was slowing down, that allowed the market to stop thinking about how bad is it going to be and start thinking about reopening. And if you need any evidence that the virus and vaccine news is driving stocks, just look at what's happened this week, right, with Moderna. I'm sure a lot of people saw this. On Monday morning, news hit the wires that their vaccine trials are looking good, showing effectiveness. And as a result, we had the best single day for stocks in about 6 weeks on Monday. And then yesterday at about 3:15, some news hit the wire of just speculation from scientists that, hey, maybe let's pump the brakes. Maybe this data is not as significant as we thought. And then we saw about a 1.5% sell-off just in the last about 45 minutes of trading. So again, just to underscore how important the health news is right now from a stock perspective. So that's number one. Number two, more recently, the actual reopening of states has really added to the bullish sentiment. I believe as of today, every state, almost all, if not every state, is at least partially reopened in some capacity. And I think we're starting to see small silver linings here and there that people are starting to get back out and about, albeit it's muted, right? So if you look at TSA screens passengers every day, right, that gives you a gauge on who's flying. About 5 weeks ago, it hit a low of 87,000 nationwide that they screened. On Sunday, they hit about 250,000. So still down a ton. We were averaging well over 2 million screened a day a year ago. But significantly up from the lows. So you're starting to see a little bit more activity there. The same thing's happening with restaurant bookings in some of the states that have opened up. You're starting to see small rebounds there. So those are some optimistic signs that as we open up, people are starting to re-engage the economy. And thankfully, so far, some of the states that opened early, like Georgia, for example, haven't seen a spike yet in cases. But they do tend to lag. So that's one of the most important things that I think we should look out for here is what's going to happen with the rate of infection in these states that did open up. So it's something that, again, I know I'm watching and a lot of folks are watching very, very closely. So more to be seen there. And then lastly, in terms of the third factor that's really been driving stocks is policy support, both from Congress, but especially from the Federal Reserve. It's really given the market confidence that they're going to continue to backstop the economy, do whatever it takes to keep things under control and keep us from slipping out of control. And I think this is one of the many reasons why another Great Depression is not a likely outcome. And that can't come straight from the voice of Chairman Jerome Powell. He actually just said that on an interview that aired on Sunday. Because during the Depression, the Fed, raised rates, they tightened policy, and they actually made things a little bit. Well, other people think they made things actually a little bit worse. In today's crisis, the Fed, they jumped in immediately. They cut rates to zero. They're pumping, billions of dollars in liquidity into the system. Really help to keep markets functioning in an orderly manner. And we've seen similar support on the fiscal side, small business loans from the government, enhanced unemployment benefits, even direct cash payments with talks of more going to Americans. So I think these are the three things that have really driven us to where we are today. And I think they lead to the last point that I'd like to cover, and that's where do we go from here? Now, I am not going to bury the lead here. I have absolutely no idea. I think the people I'd be most afraid of are the ones that act like they do right now. But that said, one thing to think about is remember how I mentioned that we're up about 32% from the lows in March. Well, we were up about 30% from the lows in March back in April also. So we've been kind of flat for a while here. And the market's really been going nowhere and trading in a relatively tight range for about a month now. And it's really waiting for a catalyst that's going to cause it to move up or down. Now, what most of the experts that we're talking to are saying is that in order for stocks to go up more from here in the short term, you probably need significant improvement in a couple things. And number one, fundamentals, or in other words, we need to see the economy reopening and see everything going well, right? See consumers behaving in a way that makes them go out and start spending money again rather than staying in. And also we need to see no uptick, significant uptick in the rate of infection. So that's number one, would be a catalyst. Number two is even more of a backstop from the Federal Reserve. More policy support from the government and the Federal Reserve could continue to give the market confidence that the policy has our back there. But the flip side to that is a breakdown in either of those could send us right in the other direction. So to try to blow around this, I know all of this stuff is stuff we need to be worried about in the short to intermediate term. Long term, though, I think we're all confident that we'll eventually recover. We'll get back to a great spot. But make no mistake about it. Uncertainty, volatility, these are things that are likely here to stay for quite a while, really, until we have a cure for the coronavirus. And this isn't just me saying it, right? Just last week, the chairman of the Federal Reserve, Jerome Powell, he called the path for the economy ahead, and this is a quote, highly uncertain and subject to significant downside risks. But here's the bottom line. These are, I think, unprecedented, very stressful times for a lot of reasons. And investors and clients are likely wrestling with a lot of emotions right now. And I think that it's okay as an investor to be both terrified about the short run, right? Kind of be uncertain about the short run, but also be optimistic about the long run. Those aren't mutually exclusive. That's a totally normal way to think. But the key ultimately is having a plan in place for both. And I think this is where Tim's going to pick it up in a minute here. But me, from an investment side, I think that that's where the solutions that Lincoln offers can really help some of the more conservative clients, with their quote unquote safe money by, a lot of times I call it undoing the in uncertainty. So making uncertain certain and adding certainty to that plan. And really certainty in our fixed index annuity products, with them, they don't have to worry about the downside. It's 100% protected. What they can do then is just simply focus on that protection and focus on the upside potential with index options that have uncapped upside, I should add, and really have the ability to participate in that eventual recovery when we do see it. So in terms of prepared remarks, that's all I had for you today. I know that I'd love to pass it over to Tim, make sure he has his time here, because I know he's got some great info for you. But again, thank you. I will stick around till the end if anyone has any questions, but I'd be happy to discuss. But Tim, feel free to take it away.
Matt, thank you so much for taking time out of your day today and being part of the call here. And I know the Agency One team is, very excited to have you. So thanks so much for being available. And, as we go through these slides, I'm going to go ahead and, Lisa in the background is going to advance them as we need them and as we move forward. And I certainly want to kind of highlight, today it's an honor to be on the call with everybody. and I want to highlight three things here today. We're going to talk a little bit around building confidence in times of crisis with clients. We're going to take an opportunity here to talk about, fixed index annuities as a total asset class and the flight towards safety with consumer behavior. And then last, we're going to talk about the ease of doing business with our online, digital application process and how simple it really is to do business in this changing world. So when we think about all the materials you're going to see today, I want to make sure I highlight 100% of it is approved for direct to client use. So nothing today that we're showing to you that you can't go ahead and in turn utilize with your client presentations. So in this day and age where it's becoming more and more difficult to sit down with a client in an office or even maybe sometimes their home, the opportunity to connect digitally and remotely is even more critical. So the materials that we're utilizing today are completely digital and available for you to interact with your clients on a way that they feel safe. Now, talking about safe, in safety, there's got to be strength. And when we talk about where Lincoln has been and where we are today, these next few slides here that we're going to talk about, it talks about Lincoln's tradition. The tradition of Lincoln is over 115 years and going strong. And when we look back, we know that we've seen a lot. So we feel comfortable in the situation where we are today and offering the solutions to give the peace of mind to Americans. And we're more than just words, we're action. So let's take a look at the bottom left-hand corner of the slide that you have on your screen right now. You'll notice that our capital and balance sheet evolution from the financial crisis of 2008 to currently 2019, our assets under management, our AUM, has increased by over $100 billion. And that is because we have been directly focused on not only acquiring assets, but making sure that those assets are high quality that you can count on for many, many more years to come. Our statutory capital has also increased. And I want to highlight the bottom line there. Below investment grade assets, we've cut them virtually in half. So not only have we grown in our overall size and our overall AUM, but we've decreased the below investment grade assets we're holding on the books to make sure that we continue to be a very, very strong partner. That has continued to be recognized by all the strength ratings from all the agencies with an A+ or better rating across all four, as you can see on the screen there. And what does it mean for you? And as Lisa advances to the next slide, it means that as you take a look at what we've done in the past and what as Americans that we've seen, we've all overcome adversity previously. On the left-hand side of the screen, there's 25 bear markets that are highlighted there when you're looking at financial or epidemic related. Some of them you may remember, some of them you may not remember, but the fact is, as a society, we've had downturns before, and some of them very substantial and have changed the way that we operate as a society. When we try to understand the bear markets, if we highlight just 12 of them there on the right-hand side, whether it's the crash of 29 through the tech bubble and the global financial crisis back in 07, 08, you'll notice that the average bear market return has been a 42% drop. Most recently, in what we're experiencing today, we experienced, the furthest drop off was close to 35%, when you look at where the overall market, fell. So we're right there within that average range. But the big piece to remember and to highlight with our clients every single day in a conversation is the next bull market return has averaged over 161% on the return side. As markets go up, markets come down, markets also rebound. And positioning our clients in a great opportunity to capture that upside, to continue to give them confidence is very, very important. And Lisa, as we continue to the next slide. So when you think about overcoming adversity, let's highlight three things here on the screen. You'll notice that through the chart of time, you can see market performance and how it related to those particular crises. For many of you on this call, we all know how 9/11 changed our lives and specifically impacted everybody's life when it comes down to travel and security throughout our nation. But look at the fact that we had temporary market shutdowns, record-setting drops, overall tourism, hospitality fell, but then we came back and we're back stronger than ever after those changes. 2008, 2009 was swine flu. If anybody remembers the swine flu, I feel like at the time it was kind of a bubble that was real small. But when I read these statistics, it really shocked me The way we interfaced with financially after the great, when we look at how markets corrected in 2008 and then swine flu hit, I feel like for the most part, we were a lot of distracted from what happened in the financial downturn, and we didn't really give the focus to swine flu and the pandemic that it really became on a global scale. For instance, 60 million people had swine flu in the United States in 2009. 60 million folks. We had a little over 12,000 deaths, and Congress passed $7.6 billion to fight the swine flu back in 2009. For something that, might not seem so prevalent, we've been there before as a society, and we've certainly rode the wave since 2009 straight up. Now, as we look forward to 2020, the rest of 2020, I should say, and beyond, there's a lot of uncertainty on where it will go, but there's one thing for sure, and that's as a society, we know how to, be very resilient in the face of adversity and truly come out on the other side better for it. So certainly you're looking forward to that as well. And Lisa, as we advance to the next slide. So your response with your clients matters. So back in 2008, 2009, there's a survey conducted that they interviewed thousands of Americans about their financial advisor or their agent and, asked them how happy they were with their advice. 48% of all Americans said that they would change tomorrow or have already changed their financial advisor. So almost 50% of all clients. And the number one reason, they weren't kept informed with what was going on. So that's where this particular presentation I feel is really powerful, because you could talk to your clients about stability against adversity, the opportunity to get in front of them and let them know that you have the confidence to make sure that they're in the right place as we continue to recover and come out of the situation that we're in, and they'll be in a stronger footing than ever before. On this particular slide, you will notice that there's 4 different types of clients: an opportunistic client, a client that's kind of like your steady Eddie, likes to kind of stay the course, clients that get real uncertain and nervous, and then the apprehensive client that is just completely scared and certainly goes in the opposite direction. Your opportunistic client, here's what they look like. They've invested $10,000 with you with the last financial crisis. The financial crisis hit back in 2008. You talked to them, you got in front of them, they found some extra money, they invested another $10,000, so they put a total of $20,000. That $20,000 was now worth $57,000 as of the end of 2019. The steady client, these are the clients that, they had a $10,000 balance at the last financial crisis. They said, hey, we're not going to make any changes. Let's just stay invested in the market in the way that I am. That $10,000 back in the tail end of 2019 turned into $22,000. The uncertain client, these are the clients that are saying, hey, let's move the cash and then we'll jump back in, which this particular client, you see had 10,000, slid the cash. That 10,000 is now worth $17,000. Your apprehensive client, these are the ones that went ahead and said, hey, I am 100%, I'm done, I can't afford losses, I pull out the cash. The buying power of their $10,000 today is only worth $6,500. So most clients that you have will fit into one of these 4 buckets. The opportunity to talk with them and talk to them about what the future can hold and the confidence that you have to put them on the right path is ever critical. They're seeking advice, they're looking for advice, and if it doesn't come from you, it's going to come from somebody. And you never know what that portfolio could potentially look like, not to mention the assets that can flee your books, once they find a new advisor. Go ahead and go to the next page there, Lisa. So there's never a more important time than now to get in front of your clients and be the voice of reason, be the voice that allows them to understand what is happening and make the best informed decisions. Now, as we move forward for the following 2 slides here for Lisa, I want to talk about my second point here today. Now that we've talked about the crisis and being confident in a crisis, I want to talk about the fact that there's a strategy out there that allows your clients to remove risk from their portfolio, still maintain the opportunity for upside potential, and not have any type of fees. And that's leveraging a fixed index annuity. Now, if I were to ask you, why a fixed index annuity? I'm sure most of you on this call would say, oh, well, annuities are great for their living benefits. and the opportunities for guaranteed lifetime income. And you wouldn't be wrong. And historically, that's how annuities have been sold. But according to LIMRA statistics, I'm going to share a couple years and making sure that we're looking at fixed index annuities as an asset class, not just as a product. And this is important because when you think about it, it's not about just one client that needs guaranteed income. It's about the opportunity to open up and look at your book of business and find a way to add stability to everybody's portfolio. LIMRA in 2018 totaled up all the fixed index annuity sales in the United States. They totaled $69.6 billion with a B. $40 billion of that 69, or 57%, was sold without a living benefit rider, without any lifetime income at all. Clients are scared. There's a ton of money on the sidelines, a little over 19.4 trillion with a T to be exact. Clients are looking for safe money alternatives. The checking, savings, and CD routes that they've historically utilized aren't yielding the type of returns that they're looking for. The safe money of a fixed index annuity where you have 100% downside protection, no risk of loss, and the opportunity to grab unlimited upside potential with some great indexing methods that are there. And just to show you how strong that continued behavior is, 2019, LIMRA tallied $73.5 billion in fixed index annuity sales and a slight uptick in how many were sold without a living benefit rider. LIMRA's predicting that by 2023, $80 billion annually plus will be sold in fixed index annuities across the United States. And they totally anticipate 60% plus being without a living benefit rider. The fixed index annuity market has changed. The opportunity for incredible indexing methods to add, upside potential to a portfolio without having to step out of that risk horizon and welcome in unwanted risk inside that portfolio. Now, I'm not sitting here saying that it's a great alternative to move equities into a fixed index alternative, but from an overall mindset, think about the fixed income portfolio and the opportunity to capture some yield without welcoming in any risk. And Lisa, as we flip forward to the next slide. So today we're going to talk about the opportunity with Lincoln and our OptiBlend platform. Our OptiBlend platform, where we're seeing a lot of traction and where advisors are continuing to leverage, is available in a 5-year chassis. We certainly have a 7 and 10-year long duration, but clients are speaking very loudly about a 5-year duration. They're familiar with 5 years, right? 5-year CDs, they understand a 5-year horizon, people understand a 5-year plan. 5 is very convenient and very comforting for a lot of folks. Gives a lot of flexibility to adjust as markets continue to change and update and grow over time. So we're going to talk today very quickly about why now, why does it work, and why Lincoln. And Lisa, as we go to the next slide. Why now? The impact of bond prices and interest rates, most clients don't understand. And again, all these materials here today are 100% client approved. It's important to make sure that they understand that we are at all-time low on interest rates. I mean, it's never been lower, especially when we're looking at something like the 10-year note from the U.S. Treasury. As interest rates inevitably, because the Fed said we're not looking at negative interest rates most recently during the last meeting, inevitably interest rates will go up. And that means the bond prices are going to come down. So as we flip to the next page here, Lisa, I want you to look at this chart. And this particular chart in gray, this is just a very simple explanation. If your client took a $1,000 bond with a 1% coupon and a 1% current rate, what happens if rates go down a little bit? Well, we slide to the turquoise, and the bond that they're purchasing based off the conversations that they're having becomes more valuable. That's great news. And let's look at that 10-year horizon. That bond value of $1,000 went up 9%. But we just said that rates are at all-time lows, so what's more likely? An interest rate going up? Well, let's see if interest rates go up 2, maybe 3%. That same 10-year horizon on a 10-year bond fell 17% in value. So then, from a client's perspective, how can we get better? Well, as we switch gears to the next page here, Lisa, think about the fact that a fixed index annuity is not subject to that same type of bond pressure that you're going to go ahead and get as interest rates rise. So in low interest rate and rising interest rate environments, there are better solutions to grab yields and add returns back to the portfolio, again, insulating from risk. You have the power of protection. The client will never, ever have a negative year with a fixed index annuity. They have the growth potential for uncapped earning strategies, and we're going to talk about just one of them here today, but uncapped earning strategies to maximize returns into a portfolio as markets continue to grow. And they never have to worry about a recovery because they never participate in the downside. And Lisa, as we forward to the next page, please, if you don't mind. Lincoln, in our OptiBlend platform, we have 5 different methods. Whether your most conservative client loves the fixed bucket, kind of like a similar, fixed annuity, make a set interest rate over time of the contract, and then multiple indexing options, whether you like the S&P, and we have one with Fidelity, which we're going to talk about here today as we advance to the next slide. I want to highlight Fidelity, and there's a reason for that. When you talk about dividend investing, it's a very powerful way to add yield overall to a portfolio, whether it's in an annuity or not. As a matter of fact, it's a strategy that's used time and time again to maximize portfolio worth. We have a partnership with Fidelity, and we have their Fidelity Index, which does have a ticker symbol and is available, and you can grab from Craig later after the call. This particular index holds 125 high dividend paying companies. A lot of the Russell 1000, though it's not mutually exclusive, it is sector agnostic, so great opportunity to be very diversified and grab in any type of dividend that they can. The dynamic allocation includes some U.S. Treasuries and also cash. And what that allows them to do is, as Treasuries put down pressure in a rising rate environment, they can spin out of those Treasuries and hold cash and maximize the equity returns inside the dividend holding portion of that portfolio. This Fidelity Index has averaged over 7% over the last 10 years, and last year alone produced over 10.3% return. It is a great opportunity for your clients to participate in the upside without ever having to worry about any of the downside. Now, Lisa, as we move forward to the next slide, certainly one of the examples I want to show you on here is this talks about the impact of dividends. And it talks about a couple different scenarios. It talks about the fact that, 10-year treasuries below 4%, has been there before. The last time it was there for 34 years. And certainly previously before that, it was 31 years. Well, let's just look at the fact that last time it was there for 34 years. The average S&P index return was about 10 basis points, minus 10 basis points. But dividends included a 5.4 or 540 basis point average return, contributing to the S&P growth. So we're in the middle of a 10-year treasury where we've been below 4% for close to 13 years when we think about where the U.S. Treasury here is. So certainly, very close to that scenario in some different perspectives. In the second scenario, let's talk about the 2000s, extended bull market run. The S&P index, was about minus 90 basis points, but dividends added about 1.8% to the average return. And we're in a very volatile market after the longest bull market run in history, and no one can predict what happens next. But this little circle that we see on the right-hand side is a very powerful percentage. If we look at the returns of the S&P over the last 30 years, 50% of those returns have been directly attributed to dividends. 50% of the growth of the S&P 500 is directly attributed to dividends. Having an opportunity for dividend style investment inside of a portfolio without adding any risk has never been higher. And Lisa, as we transition to the next slide, I want to take an opportunity here today to let you know that when we're talking about putting confidence back in the conversation with your clients, reassuring them that they're on the path to financial success, especially as they enter towards their retirement phases, the opportunity to capture upside potential with a fixed index annuity like Lincoln's OptiBlend that gives you the flexibility of multiple indexing strategies, including a very powerful dividend story brought to you by Fidelity. The consumer behavior that is saying they want safe investment strategies without the fear of risk has never been more critical. Now, I want to thank you for your time, but before I wrap this up and I send this back to Craig, if this has resonated with you, I want to make sure I leave you with a thought. How easy it is to do business. Now with Lincoln, we have an online application. And a lot of people are going to scratch their head and say, well, I've done paper my whole life. I love the way paper feels. I love the interaction with my clients with paper. We know it's difficult to meet with clients. Our digital platform is so simple. The online documents mirror that of the paperwork you've already looked at. You're literally just clicking through the document in a self-serve, filling it out as if you were as it was on paper. 40% of all of our applications are completely digital leading up to this, and it's growing very rapidly now that everybody's working from home. It's very simple, like I just kind of walked you through. It is just like paper. And the digital signature process is even easier. You fill out the application, you can go ahead and send it via email. Your client clicks on it, attaches their digital signature sitting at their desk in their home or on their iPad, on their couch. They hit submit, the application comes right to Lincoln completed. Completely digital signed, the whole process is that simple. What's nice about this for you, it minimizes any not in good order items or NIGO items because the app won't let you proceed unless all the lines are 100% completed. So you don't have to worry about, I skipped a line, I missed an opportunity for a signature. Decreasing the amount of times the app has to come back to you, the client, increasing the confidence with your client that you had everything all completed, everything was ready to go, and the process allows us to request money even quicker from potentially a surrendering carrier or process the cash that you send in. So with all these three things here today, I hope you understand, and I hope you walked away with something a little bit stronger around the fact that Lincoln's here to help you make sure that you maintain confidence with your clients. We have great strategies for your investment portfolios with your clients, and we make ease of doing business with your partners here at Agency One even easier as you continue to move forward in what we're calling the new normal every day. With that, I want to say thank you to Agency One. I want to say thank you, Craig, Kathy, Lisa, for all your help, Matt, for taking time out of your day and being here. And I think Craig wanted us to open it up for a few questions for Matt and I. So at this time, I'll kick it back to you, Craig. Thank you.
Thank you very much, Tim and Matt. I do not see any questions in the chat, so I will conclude here. So we hope that you found some valuable information today, and that in spite of all the turmoil and uncertainty that Matt discussed, that there's an important realization that you as an advisor have an important role to play in helping guide your clients to success. Hopefully you can think of some clients who can benefit from your checking in to provide some steady guidance or voice of reason, or maybe some that are in a position to benefit from de-risking part of their portfolio through some of the strategies that Tim talked about. Either way, we want you to know that with the support of Lincoln and our carrier partners, Agency One is here to help, and we look forward to working with you and helping you and your clients. So thanks again to Tim and Matt, and I will send it back to Kathy for some last-minute housekeeping items.
Thank you, Craig. Thank you, Matt and Tim. Very informative. We keep hearing about the fact that clients want safe money, and you certainly showed us, I believe, that there are safe money options available right now in the marketplace. This is the last webinar Agency One is going to be hosting for this week. We are taking Friday off. We are going to resume next Wednesday at noon. The schedule is still being finalized. Please look for your emails to see what we're going to be offering next Wednesday and next Friday. I wish everybody a wonderful Memorial Day weekend. Happy, healthy, and safe. And if, as Craig said, if Agency One can help you in any way, please let us know. We are open and fielding calls from all of our advisors. We just did have a question, which was, are the slides available? And yes, they are. They will be on our website. And if you've got any questions, please reach out to Craig or to myself or to Gonzalo. Thank you, everybody. And again, we look forward to connecting again next week, if not sooner. Take care.